Okay, welcome back. Hope you're sufficiently caffeinated. We have three more sessions for today, and one of them is on a topic that we've never really discussed on the CVC stage about liquidity and market making. And our wonderful Demelza will be moderating and introducing our speakers.
Thank you very much, Nikki, and thank you all for coming to the conference today and listening to this panel on market making. So I want to go ahead and get started and let each of the panelists introduce themselves. Maybe we'll start with Jonathan.
Sure, hi. I'm Jonathan Mathai. I'm Chief Product Officer and a co-founder at G20. We're a crypto and cross-asset trading firm and infrastructure as well. Before G20, I was at UBS for 10 years, initially as a quant and later as an emerging market options trader. At G20, I helped build out our product area. We're active in market making and OTC, treasury management, and also some infrastructure services as well. Thanks.
Okay, I'll go. Welcome, everybody. My name is Marc Meuwissen. I work at IMC. I live in Amsterdam. I joined IMC back in '94. That's a long time ago. I left in 2010. Then I did all kinds of other things and then got interested in crypto, started a little crypto trading firm in 2017, and that became part of IMC in 2021, and that was the start of IMC Crypto. And now IMC is, what's a big name in traditional finance, but now it's also going to be active in the crypto space.
Excellent.
Hello, everyone. I'm Kevin de Patoul. I'm the co-founder and CEO of Keyrock. So Keyrock, we're a market maker, liquidity provider in digital assets. I founded the company back in 2017, and today we provide liquidity on more than 85 exchanges, centralized, decentralized, making more than 500 markets 24/7. Same thing, doing market making on venues, off venues, OTC, working a large variety of instruments. And yeah, very happy to discuss this topic with everybody here today.
Excellent. Well, thank you very much. So we have Jonathan from G20, Marc from IMC, and Kevin from Keyrock. So these are, I think, some of the most well-known market makers in the space. But I think for me, as an average trader for cryptocurrencies, I don't even realize you guys exist. Like, my trades just get executed when I click buy. And I think, maybe it would help me understand, if I'm 5 years old, explain it to me in a really simple way. What do market makers do in the cryptocurrency space?
Sure, I can take a go at that. So imagine, actually, we're all 5 years old and in the same class. And we love this one particular toy that we love to buy and sell to each other. So in that situation, you can imagine that a load of chaos. There's going to be 5-year-old FOMO with everyone trying to buy the toy, and then sometimes no one wants to have the toy at all and tries to sell it and so on. So in that situation, it's pretty chaotic and so on. So you step into the situation, you call everyone, and you say, instead of trading with each other, why don't you come to me, and I'll provide you a price always where I buy and a price where I will sell as well. So in that situation, you're acting like a market maker. You're providing liquidity. That's the ability to buy and sell in a marketplace, to a marketplace, and you're available all the time.
Okay, so in that example, you have to have a stock of the toys. And
Exactly.
and you have to have a stock of some other asset. So you're always prepared to sell the toy and then get that, or you're always prepared to buy the toy with that asset.
Exactly. Yeah.
Okay, perfect. Okay, and now in the traditional space, well, that's kind of how it works in the traditional space. What would be the parallel in the cryptocurrency market? Like, how does that work? Maybe, Marc, if you want to explain.
Okay, I can have a go. It's basically the same, right? So we make markets. A market is defined as a combination of a buy order and a sell order. So that's what we do in traditional space and also in crypto space. And doing that, we provide liquidity, and it's the other key word that Jonathan also mentioned. Because there's no exchange without liquidity. And liquidity means that if there's no liquidity, you would never buy anything because you're not sure if there's ever going to be a buyer for you if you want to get rid of it. So we provide that liquidity by always putting in the bid orders and the sell orders at the same time. In traditional finance, these markets have existed for way longer than the crypto markets, of course. So there's a lot of competition. So there it's really, there's not that many market makers anymore because they compete on speed and on size of trades. And there's really, for IMC, for instance, there's so many markets, asset classes we are active on. It's just really hard to compete with that, and a few are. But in crypto, it's different because there's not that many big products. Well, there's Bitcoin and ETH, but there's really thousands of tokens that also need market makers to provide liquidity. And there is less competition, but that's also harder because there's also less trading in it. So that's a different game in that respect. I hope that's clear. Anyone can ask questions, right? If they
Sure. Also happy to take questions. So basically, in the traditional market, like let's say you're on the New York Stock Exchange, you want to buy a stock. There's a market maker behind the scenes that's making sure that those orders are getting executed. Likewise, in cryptocurrency market, like Binance, that's the same situation. So you would have a market maker there who's trying to make sure that if I've got US dollars, I can get the Bitcoin and vice versa.
I mean, I think that the logic applies to digital assets, the sub-part of it that is crypto, a traditional market, but actually it applies to any type of market. Why do you go on the marketplace? Is that you want to be able to exchange something, right? You want to exchange an asset for some fiat, you want to exchange a toy for candy, whatever, you go to a marketplace to be able to exchange, right? And it's great for you to rely on the fact that somebody else will come on the same market as you at the same time to do the exact opposite transaction at the same price. That sometimes can happen, right? But it is better to make sure that you always have kind of a backstop where you know that some players like ourselves are professional market makers and will basically always be there. So if you go on Bitstamp, Kraken, Binance, any other exchange, and you actually buy, it may very well be that it's another retail trader that is doing the opposite of that trade at that moment, right? But it could also be that there is a professional market maker like us, because of course it's in the interest of the exchange and of the marketplace to know that there are some players like us always providing liquidity on the market, basically. And that logic of the added value of liquidity applies on any types of market, being financial markets or other types of markets, basically.
Okay, so when I go to do a trade on Binance, I don't know if the other side is a market maker or a retail.
You don't know if it's a professional market maker or not, but when you open, if you open on your laptop, you open Bitstamp today and you place a limit order, you're making one side of the market, right? So anybody, any retail can be a market maker, but you don't know whether that order that you're going to be taking, you don't know if it's there by just a retail player that happens to want to trade at that particular price at that particular moment, or whether it's an order coming from a professional firm like ourselves that is providing those orders 24/7, basically.
Yeah, I know.
But it doesn't matter.
Maybe you can explain this to me. Like, I noticed that like there's maker and taker fees, right? And if I just do a market order, I pay a little bit more than if I do like a limit order. Is that correct?
Yes.
Because I'm helping provide liquidity for the order book. Is that why I'm getting a slightly lower fee if I do a limit order? Or?
That's going to depend from exchange to exchange, right?
Okay.
Each exchange can have a different policy. There is, in general, at least in crypto and digital assets, on average, you're going to have lower maker fees and taker fees.
Okay.
The reason is that as a maker, you are providing liquidity to the market. As a taker, you are taking liquidity away, right? As a maker, by definition, you are always on the wrong side of the market, so to speak, because if I make the sell side, I'm going to be selling what everybody wants to buy, and you're always on the wrong side as a maker, and therefore there's kind of a compensation for that, is that, okay, you are providing liquidity to the market, therefore taking potentially a higher risk in your position, and that's why you have potentially a lower fee. But that depends from exchange to exchange. It's kind of a business decision from the exchange as to how they want to attract market makers or market takers, which one they want to attract most volume from, and how they want to go about it. That's their business.
That makes a lot of sense. So I think I kind of understand the basic purpose and use case of market making and how it works. So in terms of like size, would you say that, Bitcoin has more market making on it, or like a smaller coin, maybe I don't know, like take a Rocket Pool or a Lido or, a render token, like one of the, sub top 50 market cap coins. Which of those would have, maybe more market makers involved in that market?
Yeah, I think the lower down the coin market cap spectrum you go, the more likely you are to find a market maker involved, because there's not as much natural liquidity. And it's harder to find your natural offset. There's probably someone always wanting to buy or sell Bitcoin, even from a non-professional market making stance. But it's maybe unlikely to find someone who's always willing to do the other side on a lower liquidity token.
Okay, that makes a lot of sense. So, okay, maybe going down into a little bit of a deeper dive on market making, let's learn a little bit about each of the firms that you work for. So, maybe Marc, you can tell us, are you involved in spot market making or derivatives market making?
Both.
Both.
Both, yeah.
And IMC's traditional market making was in equities, or?
Originally it was options trading, but then you also trade the spot, of course, the stock. But nowadays it's in all kinds of asset classes, with the exception of FX. But it's anything else: bonds, stocks, futures, whatever.
Okay.
And in crypto, it's futures, perps, spots, but also centralized, decentralized.
Okay, and Kevin?
So same thing, we're active on digital assets only. So Keyrock, we started a company in 2017 with a pure focus on digital assets from the start. So that's the only market we're on. But within that market, we trade spot, we trade perps, we trade options, we trade all types of instruments on centralized exchange, decentralized exchange.
Okay, and what about G20?
On the G20 side, we're active. We actually came from a traditional finance FX background, but we branched out into crypto as well about 4 or 5 years ago, and we're active on the spot and derivative side. Our focus is options in particular on the derivative side.
And what are some of the platforms where you're active? Like, is it OTC desks? Is it exchanges? Like, who are you doing market making with?
Yeah, so it's across the board. So on lots of different exchanges, I think it's the same for all of us on that side. And I guess maybe the flavor for each of the different firms would be who we partner with in particular. I think we'll each have special relationships with, one or two exchanges and so on. As an example, on our side, we're partnering with Bit.com, one of the upcoming crypto options exchanges, to do altcoin options market making on that side.
Bit.com?
Yeah, that's right.
Okay.
Part of the Matrixport group.
Oh, part of Matrixport?
Yeah.
Okay. And Marc, what?
Yeah, well, I think anybody would be on Binance who trades spot. Anybody who trades options would be on Deribit, maybe on Paradigm. And then after that, maybe we focus on the biggest exchanges. So that would be OKX, Bybit, just the big names, and also on a few specific ones. But that is on because clients require us to be a market maker for them, a liquidity provider for them in a certain exchange, and then we onboard and connect there, and then so it grows also that in that direction.
Okay, and Kevin?
I'm not going to have a very different answer. Like, I think the list of the markets we're not trading on would be a lot faster to make than the ones we're actually trading on, because we've integrated around 90 exchanges over the last 5 years, centralized, decentralized. We have our own OTC desk. We stream prices in other venues as well. So it's really, I think, same reason, I guess, why we're also active on, spot, perhaps option. It makes sense for a market maker to have very different type of flows coming in to manage your risk as well as you can. And if you narrow your focus on one type of market only, you kind of lose that ability. So we trade on a very wide spectrum.
Okay, so is there a market where nobody market makes? Like, is there an exchange where nobody's active?
One that closed down, I guess.
Okay, yeah, they had their primary market maker partner. Okay.
I guess on the decentralized side, I guess you can argue that the AMMs are not really a market maker as such, but an algorithm handling that.
And would somebody like Goldman ever get into market making on these exchanges, or is that just are they never going to take interest in it?
I think they would get involved on a regulated platform like the CME, for example. I know that typically the big FX banks tend to work fairly heavily on the CME for the FX business, and it's fairly natural to assume that they will make that leap at some point on the CME, on the futures and options side.
I mean, I think on that it also depends how you define digital assets, right, and what is behind it. If you look at digital asset at large today, what crypto is and what most of people trade on is kind of a very small part of what digital assets could be. In Keyrock's view, all assets would eventually be digital. So the same way that Goldman Sachs and other very large actors make markets on equity, they're going to continue to make market on equity, but that equity will actually be a token. It will actually be a digital asset, and therefore they will get involved, unless other players got too big in the meantime.
That makes a lot of sense. So basically, if I understand you correctly, you're saying that one day all equities will be digital assets.
Yes.
And therefore, Goldman, because they market make with equities, they'll be market making with digital assets.
Yes.
Okay. I like that point a lot. So would you say right now that maybe there's an opportunity for market makers in the cryptocurrency space because maybe some of the larger players, like you said, will only go on regulated platforms? So is there kind of an opportunity right now to get involved where they will not?
I mean, I would say yes, but not for that reason.
Okay.
I mean, I don't think that the opportunity in digital assets is around a regulatory arbitrage. I think that there are definitely opportunities because of the nature of the market, how open it is. You have the barriers to entry are a lot lower than on the traditional market. I mean, anybody can connect to the API of an exchange and start making markets algorithmically very easily in digital assets, which you cannot do on a traditional market. So I do think there's a tremendous opportunity also because the market is very decentralized and therefore is very fragmented, and that creates opportunity in and out of itself because the price is never 100% aligned everywhere. So there are definitely very big opportunities as market makers on digital assets, but I don't think that the reason is the current lack of regulation. If anything, I think that the lack of clarity on the regulatory side is actually more of a hurdle to the growth of the space rather than the root of its opportunity.
Okay, interesting.
Yeah, I think that's definitely the case, and then I think with crypto in particular, I think the opportunity is really big, and there's a lot more space for more players to come in. Actually, I'd say if you look at the FX business in general, there are maybe 40 or 50 big banks, investment banks or so, each of which acting like a market maker in the FX space, right? So if you try and look at that analogy into the crypto markets, there are not that many players there really who are on that same order of size type thing.
Okay, so are there bigger spreads in the cryptocurrency market? I mean, since some of you come from traditional market making on traditional markets, and you've kind of come into the crypto space now, that would make me think that there's more money making opportunities there, maybe because those 40, 50 large players haven't come in. So how do market makers make money? Maybe Marc, we can start.
Yeah, but that is actually the first thing you said is another difference between the crypto space and the traditional finance, that there's so many exchanges that I guess maybe the depth on each exchange is smaller than you would expect in the traditional equity market. But if you aggregate everything, it is really very, very liquid in most tokens, I guess, in the bigger ones. Your second question, how do market makers make money? I thought about it because I've had that question before. Well, if the price is, let's assume the price stays the same, right? And we are the best bid and we are the best offer, and there are people happily buying and selling, then we earn the difference, right? So that is something we can do. Then the magic starts when the spot or when the underlying gets to move, and that's where the algorithms and the computers take over. Because how are you gonna adjust you're gonna adjust your price, of course, but are you gonna you just bought and are you selling now lower or are you buying more? And that depends on a whole variety of related products, for instance. That is all going to be quickly calculated, and then it's all automated, of course, but then the algorithm decides what your next step is. So are you going to aggressively get out of the position that you just traded in and that's losing money? Or are you going to accumulate more because you think it's going to go? So there's some kind of a very short-term price prediction in the trading models that makes sure that you can always stay with a pretty close small difference between your bid and your ask in all these products at the same time. And it can happen that you adjust your price here because you are trading there.
Okay.
Right? If you're buying here, you don't have an opinion on the market. You don't say, I hope we're going to buy Bitcoin today because we think it's going to go up. If we buy Bitcoin here, we're going to sell something else there. And maybe it's not even trading, but we will adjust the quote. So it's going to be more likely that we sell it there. And then maybe our dollar delta is flat again. That's also a term that's quite common in market makers.
Okay, so even though we call it market making, it's not really a uniform strategy. Each market making firm has its own algorithm.
For sure, yeah.
Okay, and then it's kind of like over time, some algorithms will do better than others, some market makers will...
Yeah, in some market conditions.
Okay.
Yes, I think the points there are around what a market maker does. So they have to manage inventory, and they have to think about their fair price. So if you look back at that example with the classroom, maybe the market maker there would realize that the price tends to spike after pocket money day, when everyone's trying to buy the toy and so on, and would collapse just before the sweet shops open or something like that in this classroom example. So, part of that as a market maker, to manage your inventory, you've got to be thinking about what can be possible triggers for moves in the market and position yourself accordingly. You don't know what's going to happen, but you're going to give yourself a best shot for that. And I think that's typically the case in the less liquid tokens where supply and demand are really hard to track.
And I think that what you said actually, that different market makers are going to have different strategies, different risk profiles, different ways of managing their inventory is one of the reasons why, when working with token issuers, for example, we always advise to work with more than one, because it is in the interest of the market to not have only one market maker active on it, because you want to have that diversity in risk profile, that diversity in risk management that actually eventually benefits the market, which of course is in the interest of the token issuer.
Okay, I think I understand. So onto that point, you're saying, Kevin, that basically tokens come to market with a market maker, or they can engage a market maker to provide liquidity for them on, say, an exchange like Binance or Bybit, and then or do they come to you with, they say, we know the exchanges we want to be involved in, and this is where we want to go live, and this is we want to have it with this fiat pair, Australian dollar on this exchange, or do you guys come to them and tell them what the strategy should be for market making, or how do you approach a client, or how do they approach you?
I mean, there are as many answers as there are individual token issuers, basically, right? But I think that what is interesting there is first is understanding why is it in the interest of a token issuer to have market makers active, right? And we explain what liquidity is, but why is it interesting? Why is it important? And the thing is that having a very liquid market benefits all market participants. Because if you have a very liquid market, what it means that you can have a very tight spread. So it means that when you do a market order and you cross that spread, you're basically going to be trading at a cheaper price than if you had a very wide spread. It also means that if you all of a sudden want to execute a large order and you want to sell, 10 Bitcoins or 100 Bitcoins, you're not going to move the price by 5% because there's nobody that wants to do the opposite trade. So you end up with basically a market that is more fair, that is more efficient, that is less volatile, that is less prone to manipulation. So all of those things make it interesting and actually important for token issuers of assets, actually, asset issuers, to have market makers working with them. Some of them come to us, some of them we go to them, right? Some of them are listed already and they want the markets to get better. Some of them contact us before they even get listed, so that we can help them on, advising where to get listed, one exchanges, many exchanges, which pairs, how to get started. So that's part of our job as a service provider to answer very different situations, basically.
Interesting. So yeah, I can't remember one of the projects I was advising at some point. They wanted to get listed on an exchange, and the exchange said, well, who are your market makers? And then they said, well, I don't know, we don't. And then they said, well, we're not going to list you unless you can tell us who your market maker is. So is that pretty common that the exchange expects the project to onboard with a market maker?
Definitely.
Especially.
Okay.
And it makes sense, right? So for the market maker and for the project and for the exchange, you're all on the same side because you all want a nice tight market in that product so everybody can trade it, and the exchange wants the volume, we want the volume, and they want, as Kevin said, they want lower volatility, the same price on different venues, so it doesn't matter where your account is sitting, if it's Bitstamp or Cracker, we have to make sure that you pay the same price, more or less, and you sell at the same price.
Okay, so would you say that there's kind of like two broad categories of market makers, basically like the prop desk market makers that are trading with their own money, they don't get involved with token projects, they don't take on external investor money, and then there's the second type of market maker, which is kind of working with tokens, they have clients, they kind of have mandate or they have some type of, arrangement. Would you say those are like the two broad types of market makers, or are there others?
Well, you have three types. One that only do prop trading, one that only do trading, the token market making, and some that do both. I guess we all three do both. Yeah. And it helps, they help each other because because we do quite a lot of volume on the main exchanges, we are very high fee tiers, so we trade cheaper than we would do without.
So on that, maybe just to clarify, on our side, we really focus on the service side of things. So all the markets that we make, we actually have a dedicated contract with either the issuer or the exchanges. That's really our focus.
You have a contract with the exchange or the contract with the...
Or the issuer.
Or the issuer.
It depends on the market, right? But
Okay.
like the things that a contract with the exchange can also be just part of their dedicated market maker program,
Okay.
which is available to anybody that wants to trade high volume, right?
Okay.
And so that creates kind of a partnership with the exchange. But that's really what we currently focus on.
And what does high volume mean? Like, give me an example of an exchange and what I would need to do on a daily basis in order to be part of their market making program.
I don't know, Binance VIP9 is hundreds of millions per day, I think. Hundreds of millions of volume
Hundreds
per day.
of millions per day
Yeah.
to be part of their VIP program.
VIP9,
Wow.
so you have different tiers, right? VIP
Yeah.
1, 2, 3, 4, but that's,
And then
it's on the website of Binance. And
the tiers of market makers mean you get better fees.
Yeah, exactly. The more volume you trade, the lower your fees.
Interesting. Okay, so now does that mean that each of you has to keep inventory on all the different platforms that you're on?
Yes.
Yeah, that's right.
Now-
There are some solutions now, I guess, like which have off exchange balances. I think Binance has a solution, and Copper is an example, and other places. But yes.
They have a solution so you don't have to keep full inventory on their platform. I mean, because that seems like it would be quite a large risk for a market maker if they've got liquidity on FTX or
It's definitely one of
you know,
That's a good example, yeah.
That's your big
other
risk.
ones, you know. I mean, so how do market makers kind of protect yourselves from that?
I guess
Do
you
you- do
can't
you- Mm-hmm.
overall. I mean, it's probably, I'm sure, the biggest fear that we all have, that one of the exchanges goes down, and you have to do your best to be ahead of that situation. But sometimes you just can't know, I think.
Yeah, but it's true. You got to be capital efficient. Some exchanges we won't touch,
Yeah.
and on smaller exchanges you typically need less capital because
Okay.
you can assume that the risk is there a bit bigger, but you can never be sure. But because also just getting back to what you first said, both prop trading, well, by definition, but also token marketing is on our own book with our own capital.
Okay.
So that is similar.
So I don't want to drop any names, but are there any exchanges you want to mention that you're not willing to market make on currently?
No,
I see a sniper in the audience. It would be dangerous to say that.
no, that would be really bad. No.
Because then if they have a token, we could do some things. But great, okay.
Maybe actually, you mentioned the difference between traditional finance and crypto and digital asset. That's a very big one.
Please.
Like having exchanges that do both marketplaces, like exchanges are marketplaces, but also they do the custody. That's not something that is common or existing at all in traditional finance. Something that is a very specific risk to making markets in digital assets that the exchanges are doing both the marketplace and the custody.
For example, is that what happened with the big blow up that
So
they
FTX,
had
they were
custody
doing,
and they were
doing but just that's not an exception of FTX. Like most exchanges today in digital assets, as you say, you need to put your assets there.
yeah.
So if the exchange goes down, as did FTX, you lose your assets, or you hope to get them back at a later date, depending on how good and cheap the legal team working on the unwinding is. But that's another debate. But that's exactly what happens.
So if you market make on Robinhood for equities, you don't have to keep your inventory on Robinhood? Or like if you're in any exchange, if you're in any traditional market, who keeps your inventory? A custodian bank like Deutsche Bank or somebody keeps it, and then you have an API that tells them what your algorithm goes to the exchange and
exactly. So you have a separation between the marketplaces and the custodian, and then you have clearing and settlement that happens, on a variety of time frames, but you have a reconciliation between. But exchanges don't do custody usually.
So market making on crypto then is riskier.
For that, yes.
I guess there's 2 points to that, though, because in crypto, at least you know pretty much your risk. So if you've got 1 million deposited on the exchange, that's your risk. But in traditional finance, usually you can get margin called. So you have if a trade particularly goes wrong on traditional finance, you can get margin called for even more. So sometimes it's hard to kind of bucket your risk in that case in traditional finance.
Okay.
But I think this whole point, though, is probably talking for market makers. It's a reason why it's a service, and we need to get compensated for that because we're taking risk and having to manage these things.
Definitely. So, okay, if I'm understanding this correctly, we've got the spot price of Bitcoin, we've got market makers that have a bid-ask around that spot, and it's going to be a wider spread on less liquid coins, less liquid fiat pairs, less liquid exchanges. And
Well, it's not per se wider, but it's smaller.
Okay.
So it's for less capital.
Okay.
And there's multiple bids and offers.
Okay.
So you can put bids and offers. You can put multiple bids and offers in at the same time.
Okay.
For smaller size. So that's what you would typically do if a token is very illiquid.
Okay.
Because you don't want to buy a whole lot at some price and then there's no one else. So sometimes it's nice as a market maker to have other market makers support. So there was also something you said. It's sometimes good to have multiple market makers on the same token because then you can just make it more stable if you all work together in a way. Well, you don't you don't do that, but you don't make deals or anything. But you do all put your bids in. So it's one of the, as I said, one of the main reasons for this token market making is that you want to lower the volatility.
Interesting.
I mean, that's what's happened in traditional finances as well. And so if you can use FX as a template. I mean, I remember 15 to 20 years ago, it was really illiquid. It was much less liquid in FX, and people would do much less electronic trading. There was visible arbitrage. The spreads were wider. And then over the last 10 to 15 years, things have become a lot more electronic. There have been a lot more participants in the market, and things are incredibly tight there now. Like Eurodollar, for example, quoted at fractional basis points now, which is really, really tight. So exactly like what Marc was saying, the more that we get market makers involved in the market, the more the competition is good for the market.
The more efficient the markets
More
become.
efficient, yeah, exactly.
Okay. So as like just a retail trader that I'm on Binance and I want to buy a coin, if I see a lot of volume in that coin, and even some of like the screener tools, there's some of the buy-sell strategies people have is based on volume. So people are like looking at volume. If it's a small coin with no volume, maybe they're not so interested. If it's a large coin with a lot of volume, they're thinking, oh, people are interested in this. But maybe behind the scenes, it's just market makers trading with each other. So how do we know if it's like real volume? I mean, well.
Yeah, but we're not interested in trading against other market makers.
But you do sometimes,
You
right?
do sometimes, of course, and you don't know, but it's not where we will. It's a zero-sum game, right? You don't make money then. So I can't imagine that there's if Pepe is number 2 on Binance on a day, which is crazy, I think.
Yeah.
That will not be market makers trading with each other.
Okay.
No.
Interesting, because it seems like you could almost make a coin seem more popular than it is if you get 4 or 5 contracts with market makers too.
But
Trade against each other.
there's the thing.
That's like market manipulation almost, right?
If
you're just people making markets, you're a market maker.
Yeah.
You're not a market taker.
Okay.
So the reality, if you have 2 makers, on the price that is stable, you don't have trades. So you have 5 market makers. What you see is an order book that is very full. You have great outstanding liquidity. You see that the price is going to be stable, but that doesn't just create volume in and out of itself, right? Because you're a maker, not a taker, and to have a trade, you need to have both.
Okay.
So it makes having a lot of market makers in the book makes it more efficient for takers to participate as well, and that's what creates volume.
Okay.
But that is very real, because it's not what you have as well, and that's another problem. Maybe more linked to the earlier days of crypto, but that does happen still, is wash trading, where it's just one entity trading with itself, and that is completely fake, right?
Yeah.
But if you have market makers active in the market, that is real effective volume. So as a market participant, you have that efficient execution that you want to have because you are effectively have counterparties to trade with.
Okay, and wash trading basically, explain it to me like I'm 5, maybe if anyone wants to take that question.
It's just trading against yourself to create fake volume, so to speak.
Can you also like spoof markets where like you make the order wall look big and then you make it disappear?
I mean, people can do that.
Okay.
It's another type of market manipulation.
So that's not wash trading. Wash trading, you
No.
actually execute, like a trade goes through.
Yeah. It's
Okay.
creating fake volume out of thin air, basically.
Okay. And now, is market manipulation illegal in cryptocurrencies? Because they're not securities, right? So is it a gray area? Is it really illegal or is it totally legal? Like, honestly, I don't know.
So it's going to depend on which market, but in general...
I also don't know. I guess it could be a criminal activity. I mean, you shouldn't do it, right? I don't know if it's illegal because you don't have, but exchange must have rules and regulations around it.
Yeah. I can imagine like for a large firm like IMC that's got a traditional business, it would
We
be
would never want to be involved in anything that's
extremely
suspicious.
risky. And then maybe like
Smaller firm either, by the way.
Smaller firms, by the way.
Just to make sure that it's clear.
but maybe me with my market making bot in my mom's basement, I can do what, you know,
Whoa.
nobody bothers me or something.
Yeah.
I hope you're not on camera.
Yeah.
Okay, so let's talk about hedging. Like, if your market making strategy is buying some Bitcoin low, selling some Bitcoin high, and you know, the market moves against you, you also risk losing part of your inventory, right? So how do you kind of take away some of that risk? Maybe let's start with Kevin.
Yeah, so I mean, definitely we do hedge, right? And that's what I was saying. As a maker, you are naturally against the market, so to speak, because you are there kind of with orders that are just sitting at a price that is well known, and therefore you have a disadvantage. And so indeed, you do end up, you know, taking out position long and short that you want to get out of. So you do hedge. There are multiple ways of doing that. So the first one that is the most basic. If you trade, you know, you trade Bitcoin Euro on one market, there are 15 others, because as Marc said, there's many listings on the market, and so what you take on one, you can maybe get out of on the other, because the market is not 100% efficient and liquid. So there are ways to just hedge same instrument, same thing, simply on another exchange. You can also hedge that, you know, on another fiat, for example. So something you take on Bitcoin Euro, you can hedge on Bitcoin dollar, and then do an FX trade to get back to a position that is fully neutral. You can use different instruments. What you do on spot, you can use perps, you can use options. You can also go a bit further. If you are long Bitcoin and you decide to short Ethereum, you do get some type of hedging. That is not perfect, that is not complete, but those are things that you can do.
Fully
because there is some correlation between
Okay.
similar assets. I mean, Bitcoin and ETH might not be the perfect example, but that's the logic, right? So there are a variety of ways to be hedged, and I mean, speaking for Keyrock, as we basically want always to be hedged and be delta neutral in our activity. So we're not in the business of accumulating position and taking bets on a certain asset going up or down.
Okay.
That's not what we do.
So you're not saying like, I think Bitcoin's going to go up and taking some, so you're always trying to hedge out, and you have like, when your algorithm does one trade, another algorithm does another trade. Oh.
Yes, what Marc was saying, if you buy on the right, you're going to skew your price on the left so that you increase the probability of you getting out of that position to go back to a neutral.
Okay. Interesting. So, I mean, it really is competition between the market makers to see who can...
Friendly competition.
And are market makers like hiring quants to figure this stuff out, or who's coming behind the scenes to build these algorithms?
I think there's lots of people from traditional finance who've made the move across. I think especially as Bitcoin and Ether get more institutional adoption and they fit into the sort of general cross-asset framework, I think you can even think about it cross-asset of how Bitcoin and Ether could be correlated with other asset classes. So I think there's a lot of folks who've come over in the last 3 to 4 years from traditional finance, and some very clever folks, including at G20.
Is there like any book that people can read to, like what's your top book that you recommend for people?
If there is one, I want it.
Yeah, like Market Making 101 by somebody that did really well with that strategy or something. Is there any book, or there's like
I gotta think about that, because there are many books.
Loads of books.
Yeah,
But to
okay.
recommend one is...
But you can't get a degree in market making, like you can't.
We still have some time. I'll come up with an answer at the end.
Okay, so let's move on to the segment of this talk, which is on the shocking and ugly side of market making, okay? So what are some of the shocking facts about digital asset market making that most cryptocurrency investors do not know? Open the floor.
But I think there are many, and we discussed part of it, right? We discussed watch trading, we discussed price manipulation, and those are some of the ugly sides, right? I mean, we started Keyrock in 2017, focused purely on digital assets, and back then, actually, still now, the first slide in our sales deck was what we do not do. So we don't take price targets, we don't create fake volume, So the reason we had to say so is because it is something that was happening on the market that is largely unregulated. So, but the thing is that unknown, is that shocking? I don't think so. It's something that is known that there are some bad behaviors out there. But I think what matters is to understand the reason for market making, the purpose that it serves, and what actually good actors are providing in terms of added value to the market. And also, as I said, hope that the regulatory framework is clarified more and more so that you not only bet everything on the goodwill of actor, but you actually have a very clear framework that tells you what can and cannot be done, and be assured as a market participant that those practices are not taking place anymore.
I think the other thing is that the question has more, I mean, it's interesting in 2023 to look back at 2022, which saw a lot of the shocking things happen all in one year, with, Luna, USTs, FTX, the crypto crash, and so on. So I think, there was a lot of shocking events that happened, even for, experienced market players like ourselves last year. And kind of as many black swans as you can count. It's kind of nice to have a few months of white swans type thing in the environment.
I think I can add two things that people might not know about market makers, not so shocking, but one is that with a lot of exchanges we have obligations to be there a certain percentage of the time. So we are just not there for fun having our bids and offers, but we sometimes have just agreed on providing that liquidity almost at all times. And the second thing is that sometimes in a certain token, we are like counterparty to every second trade. The market volumes we do are really huge. And it's just, especially these less liquid ones, it's just, that's in TradFi you don't have that at all. So we do market percentages sometimes that are really incredibly big.
And so, was Alameda a market maker? Or were they just doing prop? I mean, what was their objective? Were they market making on FTX? Was that the main object? Did they have like?
I think it started like that, yeah.
Okay, it started like that. Okay, but then it went into another direction.
Yeah,
the fraud direction.
The fraud direction. So they lost money with their market making, and then they said, well, we're just going to borrow some client assets, try again, and then they lost it again.
Yeah, exactly.
Or something.
Well, I don't know.
It's hard to say what really happened underneath the hood, but
okay.
I think from our perspective, initially they were, I guess, fairly okay counterparty, and we never had anything negative to say about them. But then behind the scenes, there's probably a lot of insider information flowing between the order books on FTX, bailouts of any bad positions, and so on. It seems it's hard to say exactly, but
yeah. I mean, if you have the insider information, you'd think you'd have a better chance at succeeding. But so maybe not. So I mean, in traditional markets, right? Like they guarantee best execution, right? Like you're on Robinhood, you want to buy your GameFi or your GameStop, or what was the GameStop or something. You want to buy your stock, and the regulators have kind of made it so that you can't charge too much on that, or they want to get it executed at the best price. But that regulation doesn't exist in crypto yet. Is there any regulation that's on the horizon that's going to try to do something like that, or do best execution for market making, or would that help this market, or would it hinder it? How would?
In Europe, you get MiCA, so that's the start of regulation, right? So I think it's really good, and it's. So I'm more than a year away, but at some stage that will kick in. But best execution is not part of that, because it's also really, really hard, right? There's so many platforms. What are you going to do about DEXs? I mean, it's just who's going to make sure you can't promise best execution. I don't see it.
And you also, like we're saying, the regulation on traditional market on best execution is also. So, in the US, you have one national market, so to speak, and you need to guarantee the best execution on that one national market. In the case of Bitcoin, it's traded, in hundreds of exchanges everywhere. It's super fragmented, so it is just something that is not possible to align on a worldwide scale, basically. So it's not something that is in the plan of MiCA or other regulation that I know of.
Okay, that makes a lot of sense. So it's fragmented market, and so best execution would be very difficult to ensure, and trying to force market makers to stay in the market at all times. Finishing up this panel, how does the future of market making look? I mean, the panel is called the next generation of market making and liquidity provision. So, I mean, in 5 years when we have this panel, will it all be automated market makers and bots on this panel that are talking to each other, or will it still be people?
It'll all be AIs, no?
Yeah.
No, so I think it's a really big area of what the future holds for market making. I think the crypto market making and the cryptocurrency market in general is still pretty young compared to its traditional finance counterparts. I think the two areas, I guess, that we're really excited about are non-dollar liquidity. So I think what we've seen in up until now is that most of the liquidity is versus a dollar stablecoin or against dollars. And I think as the market matures, we'll probably see a lot more cross-currency crypto quotes, so against euro, against any other currency you can imagine. So I think that will be a big part of it. And I think the other part is around the options market in general. It's still really nascent and small in comparison to what is in traditional finance and across in FX as well on that side. So I think we'll see a lot more altcoins appear on the options side. I think that will really help liquidity as well. So at least 2 points.
Yeah, about the robots, I mean, I'm not worried about that at all. But people at IMC use ChatGPT. You can even code with it. You can let it write your email. So it's a good tool in many ways. But it might speed up developments. And then I guess there would only be more people needed, right, to keep up with that. And I think that's replacing us. I mean, we have feelings, creativity, intuition. I mean, I don't think a robot has that. And I like to think that's important parts of our job as well.
So basically, you're saying that with automated market makers, possibly, we're still going to need people to decide where to deploy those automated market makers, on which exchanges, with which liquidity pairs.
Yeah.
Like, there's still going to be people behind the scenes that have to constantly stay on the cutting edge.
What you said about AMM, so like AMMs in crypto, like it's interesting. Like when it started to become more prevalent, like those automated market makers, people would always ask me like, "Oh, so you're about to be replaced?" But the reality is that an AMM is just another type of market. You still have people that provide liquidity in those pools. When you do, you are facing with potential impermanent losses, which means that you need to hedge whatever you do there. So at the end, the way that we look at it, we trade on AMMs, we trade on centralized exchanges. We will trade in the next type of market that will emerge. There is still a need for counterparties to provide the liquidity. It doesn't just magically happen. And when you do that all the time on markets that are also not very liquid, but there's a high volatility and so on and so forth, you need to be very good at it. And you need to know how to manage your risk. Otherwise, yes, you can do it, but you will eventually go bust. So I think that is what we've seen with AMMs, just another type of market in which we are active as well. And that's the thing that is going to continue, basically.
Excellent. Well, thank you so much for all of your insights on market making today. And I hope that anyone that's interested in learning more about G20 or IMC or Keyrock can speak to these panelists after the panel, which is right now.
Yes, let's give it up for our panelists. And we can talk more liquidity on the boat cruise that is being hosted by IMC Trading. Thank you so much for making this amazing experience happen for us this year.